Are you struggling to get started as an options trader? Rest assured, this is perfectly normal given the complexity of the options market, especially if you're a newcomer. In this video, what we're going to do is we're going to break down the foundation that you need to get started as a professional day trader or swing trader in the options market. Hey traders, my name is Kozak, founder of NSTA, and for the world's best trading education and strategies, be sure to hit that subscribe button and make sure you turn that notification bell on. That way, each time you watch videos like this, you can get results. Give me a thumbs up, that way we know you're engaging the content and you're getting social with us. Now, what I'd like to do before we jump into the content is I want to talk to you about how serious it is to be an options trader. In our programs at NeuroStreet, we've got a lot of equities traders that are very successful, especially when swing trading the market because they use options as an alternative to stocks. But before you get into trading them, there's a lot of things you need to understand about the stock market and the option market and how they correlate together. And that's exactly what we're going to do today. We're going to show you the foundation that you need to become a successful options trader so you can get rid of the noise and you can empower yourself moving forward. Let's jump onto the whiteboard and talk about what we're going on here. So in options trading, you need to know why you want to use an options contract because options are a derivative of the stock, and therefore it's really critical to know when and why to use them and how to position yourself accordingly. We're going to go into the mechanics of options because there's a lot of moving parts. It's very different than just buying or selling a stock, so you want to make sure you know the foundation of that. And then we're going to talk about the different types of options contracts that are available from the basics all the way to the advanced. We're going to talk about what I like to call as the backbone to options trading, which is calls and puts, because if you really want to make money quickly and you want to keep it super simple, there's basic strategies and there's really complex strategies. And some of the most profitable traders that we have stick to the basics and just use calls and puts, and we're going to show you how to use that moving forward. Then we're going to give you a term sheet and a checklist that you can leave here because with options trading, it's very, very important that you go through the steps, you don't miss anything, so that way you're always on the right side of your trade. So what I want to do is I want to jump onto the charts. I think it's really fast and forward that we move into this stuff quickly and efficiently so we don't waste time. But if you ever have any questions on this, make sure you leave them in the comment section below. We'll see you on the screens. Okay, traders, in this video, we're going to be breaking down the first introductory course video on the Options 101 program. Now, I'm really excited to teach you this course because options trading definitely attracts a specific type of trader. And if you're watching this, then you've definitely got the itch to learn about how to use options as an alternative to trading stocks. Also, the leverage that can give you opportunities for trading as an alternative. And there's just a whole lot of different reasons why traders would consider using options. Now, just a couple of things to kind of kick the course off on the right direction. If you have never traded the stock market before or you've never taken the Stocks Course 101, I highly encourage you to stop watching this course and go to the stock program first, because ultimately options are basically derived of the stock. It's part of the stock itself. And so basically what ends up happening is if you're not familiar with the stock trading side of the business, it'll be more difficult to kind of really grasp the options trading side of the business. And options trading definitely brings a little bit more advanced concepts. So this is not normally where newer traders start. You don't normally just start trading options right out the gates. You want to have a handle first on the stock side of things before you start trading options. So with that being said, if you feel you're ready to embark on this journey, I'm very excited to take you down this journey because options trading is a very, very lucrative opportunity as long as you understand it and understand all the mechanics and all the different aspects of this space. So that's what we're going to do in this course. We're going to take you on an options course journey. We've got a lot of things to talk about. It is a very in-depth, very thorough program. So you're going to want to pause the video, take breaks, rewatch the videos, go over notes. And at any time, if you have questions, or if you need assistance, or you got to get on a call with our team, we are here to help you grow through this process. So let's get started. So let's talk about what options are. Okay, options are a derivative of an underlying asset, such as a stock or a commodity. And for the sake of this course, we're going to be focusing on options on stocks. You can trade options on other assets like futures and commodities, but it's not really where everybody gravitates to. Right? It's not really meant for the masses, so to speak. You normally find more institutional traders trading options on futures, okay? So A couple things I want to talk about here is that options give you the participation. How do I say this? Options give you, the participant, the trader, right, the right to buy or sell the underlying stock. Okay. And when traders perceive the value of the right to buy or sell the underlying asset to be high, then the value of the option will increase and vice versa, right? So sometimes people view options as being hard or complicated. However, usually this stems from a lack of experience, and rightfully so. We strongly encourage you to take the stocks course first, followed by the education and the strategies course. Since we trade options, derivatives on the other markets, you're going to need to know how to trade those markets first, because options is a more advanced way to trade them I shouldn't say advanced, I should say it's an alternative way to trade them, but it does have more advanced components to placing trades and understanding what options are. Okay. And I don't say that to scare you. I say that to bring you to the limelight, because it's the truth. It's the reality of the options industry. It's truthfully so. It's not meant for everybody. And if you feel that you want to learn options, then this is definitely the best place to do it. Okay. So let's consider why we would look at options. First and foremost, you can use them in your retirement accounts. You can take advantage of bullish and bearish positions. Like you can, instead of not being able to short in your retirement accounts because it's a registered account, you can actually take advantage of puts. Put options are a way for you to make money as the market drops in value. So it's a really good alternative, as an alternative to the actual stock side of it. You can definitely take advantage of the leverage. It's a use of protections on stocks. So let's say you own stocks, you can use options to hedge the risk. You can take advantage of different strategies to capitalize on market environments, a lot more flexibility, and you can diversify your asset coverage for different multiple streams of income. Okay. Now, most of the people get sucked into the option side of things because of the leverage and the ability to participate in more advanced strategies and more expensive stocks to capitalize on that advantage, right? And so, if you're somebody that has maybe a smaller account and you want to trade more expensive stocks, you could use options as an advantage to that. Or if you just want to take advantage of leverage because you're getting better at trading, you could use options as an alternative to buying or selling the stock. Okay, so just to kind of clarify the types of options traders, just like trading stocks or futures, option traders take different forms and styles, right? Some traders use the leverage to play directional moves on the stock. Some traders play options to profit from volatility discrepancies. Some traders use both direction and volatility. Others use options to hedge their portfolios. So moving forward, I would normally say that the 90% of all speculative traders are going to use the options market for leverage on directional moves on volatility. So you're going to basically be looking at directional plays, bullish or bearish trade activity, and you're going to be looking to take advantage of the volatility and also take advantage of the direction of the stock. So the reason this is important is, instead of you just saying buying or selling a stock, then what you can do is you can actually take advantage of that option. You could use that option to play the stock instead of actually using the stock. And that's why most people do this, is to give them an alternative volatility and directional play. And so, but there's a lot of different ways to trade options, and we're going to talk about different components moving forward. So a couple things here is we're going to start talking about the mechanics of the option. So an option is a contract. And just like a futures contract, it has its own different criteria. So an option contract has a buyer and a seller. In an options contract, okay, when you're a buyer, you're not just expecting the value to go up in value. Like there's one play on words that options lingo kind of participates with, and it's a little different than every other aspect, right? So I want to slow this down, because this is where a lot of traders get confused right out the gates, and I want to make sure that you don't get confused and we hone in on this right away. In an options contract, the buyer, let me grab the cursor here so you can see this. The buyer has the right but not the obligation to buy or sell the underlying asset, the stock, at a set price on or before the expiration date. So if you're a buyer of options, okay, you can participate in bullish options, which means you're expecting the stock to rise in value, or you can take advantage of bearish options, okay? And this means you're expecting the stock to drop in value. And so that's, as a buyer, you can participate in that. As a seller, okay, you can take advantage, or excuse me, it's, as a buyer, you have the right but not the obligation to buy or sell the underlying asset. You can, as a buyer of the option, you can participate in buying or selling the underlying asset. So the whole point of this, when you're buying options, you can take both bullish and bearish positions, okay? And we're going to get into selling options, okay? We'll get into the selling side of the options in a moment. But the point of the matter is that the word buyer does not necessarily mean bullish or bearish. It means you're a buyer of an option contract. So you could buy a call option, we'll talk about that, or you could buy a put option, we'll talk about that also. A call option is looking for bullish plays, a put option is looking for bearish plays. Okay? And so that's just where I want to make sure you get the terminology right out the gates. And options are regulated and act on as a binding contract, just like any other form of contract. It's absolutely legally tendered contracts. It's very regulated. It's a very, very professionals industry. A lot of professionals trade the options market, okay? And so let's talk about an option buyer versus an option seller. A buyer has the right but not the obligation to exercise the option, okay? A seller has the obligation of being assigned in exchange for receiving a premium when selling the option to a buyer, okay? So this basically is where a lot of traders kind of get confused, is because we can buy options, which means you have the right to exercise the option, but you don't have to. You're not obligated, but you pay a premium for that right. So you can purchase an options contract, and if that option contract expires, then you can exercise the option in exchange for the stock. As a seller of the option, you have the obligation of being assigned in exchange for receiving the premium, but a lot of people don't hold selling options into expiration, and we'll talk about that. Okay, you never want to be a seller of options into expiration, because then you're responsible. Okay, and we'll talk about that. And like I said, we're going to get into some complicated discussions here, and I know this may be a little bit overwhelming at first, but we're going to talk about that. We're going to keep it simple. Okay, and they're going to show you examples, a lot of images, a lot of visual pictorials that'll explain things so that you're not kind of worried. Because I find sometimes when I learn things, if I'm just looking at words and just hearing it, it never really puts a picture to words. I like to see pictures as well. Okay, so we'll get into that, and we'll definitely go through that as we progress through the videos. So, real simply, a buyer of a call option, okay, has the right to buy the stock at a certain price. A buyer of a put option has the right to sell the stock at a certain price. So remember on the previous video, previous slide, it says you have the right but not the obligation to buy or sell. Okay? And so that's why you can participate in both calls and puts. So you have the right to buy a stock at a certain price, or you have the right to sell a stock at a certain price. Okay? As a buyer, you can take, this is a bullish and this is a bearish position, okay? So this is looking to go up and this is looking to go down as a buyer. As a seller, has the obligation to sell the stock at a certain price. So when you sell options, you're a writer of the options contract, and you have an obligation to sell the stock at a certain price as a call seller, so you have the obligation to sell. And as a put, you have the obligation to buy the stock at a certain price. Okay? And so we're going to talk about buying options versus selling options. 90% of most traders overcomplicate options trading. And what I mean by this is there's so many different, very difficult ways to trade options, and yet there's so many simple ways to trade options. My objective through this course is to keep it super simple. 9 times out of 10, most retail traders, myself included, and potentially you, just want to learn how to make more money in a more efficient way, in a more realistic manner. And normally 9 times out of 10, you're going to be a buyer of options. You can get into selling option contracts, and there are strategies for being a seller of options. But 9 times out of 10, most traders are using buying of calls and puts. And it's so basic, but yet it's so advantageous. Okay? And so we're going to talk about that. So let's talk about stocks versus options. Okay? Stocks trade on an exchange. You have bids and offers of the sale, represents ownership in each company. You have voting rights. You can receive dividends, and it's viewed as straightforward in terms of complexity. Very basic. We've talked about stocks in the stock course. If you haven't watched the stock course, I highly encourage you to. It's very, very comprehensive. It's one of our biggest courses in the school, okay? And it's very, very needed to move forward into this course. Options trade on an exchange, and it has both bids and offer of the sale. It is a derivative of the stock. Has an expiration date on the contract. It has an outstanding float that is always changing. And there's multiple layers of moving parts, also called the Greeks, and we have an entire video on the Greeks. It is a contract, and it involves volatility in its use of value relative to time decay. And we're going to talk about that because a contract expires. So as contracts start to get closer to expiration, the valuation of those contracts changes, the time changes, the value of those contracts change, and therefore that's what makes them exciting for traders. Is not only are you participating in the direction of the stock, but you're participating in the volatility of the option itself, and also on the time, and also as things expire. So that's where options get a little bit more advanced, and we need to teach you that. Okay, so there's components of an options contract. A strike price is the price agreed in the option contract. It is the price of exchange. So when you say what's the strike price, that's the price of the options contract. Okay, the premium is the value of the contract. This is paid to the seller by the buyer. So if you're a buyer of options, you're going to pay a premium. You're going to pay a fee to the seller who's selling it. When you're a seller of options, you collect a premium, so you make money, right? So as a seller, you can actually participate in double dipping. It's more advanced. You could be collecting premiums, but you could also be making money on the option contract as well. And then there's an expiration date. The last date the contract can be enforced or exercised by the buyer. Okay, so a couple things here is, let's talk about call options. Okay, because there's the main ones are calls and puts. So a call option gives the buyer the right, but not the obligation to buy the stock. So you can buy the stock if you choose to, but you don't have to. You could just close your options contract and get out, and you don't have to participate in the stock. Most people never want to buy the stock unless there's a strategy for it. There are strategies where you intend to buy the stock, but like I said, 9 times out of 10, we want to keep things simple. So a call option is a participating opportunity for you to take advantage of having the right to buy the stock, but you don't have to. You're not obligated to. So normally what will end up happening is let's say you have an opportunity and you have a support level. Market's coming down, and you're like, okay, I want to buy this stock right here. Well, you could buy the shares, or you could buy a call option. And then the stock goes up and you make money. But instead of you letting the option contract expire, you just get out of your options contract here, so that you're never ever required, you're not obligated to buy the stock. You don't have to buy the stocks, right? You're not on the hook for dealing with the underlying asset in the contract. You're just participating on the option contract itself, which is really important. It's very similar to futures. When we buy or sell futures contracts, we're buying and selling things with the opportunity to take advantage of the direction of the market, but we never want to hold the contract to expiration, right? It's the same thing with options, right? Unless that's your intention to do so, and that's a different type of strategy, okay? Now, the right to buy is set to a fixed number of shares at a set price on or before the expiration. This is all going to be in the details of the option chain. So we're going to be going through option chains. We're going to be talking about all the different details. What is the strike price? What are the spreads? What are the bid? What are the ask? What is the options volume, right? What are all the details of the contract, right? No different than if you're buying or selling anything. You need to know what the price is and that type of stuff. How many shares, how many contracts you're buying, etc. So when you're doing call options, it's the same thing. But that's all in the options chain. We're going to look at that. And call options are used when buyers expect the price of an underlying to go above the strike price, or when we expect the price underlying to rise. So in layman's term, in monkey talk, keeping it simple, you use call options in areas where you want to buy the market and you expect the market to go up. Now, there's a little bit more to it than that, because we want to make sure that volatility is low, right? We want to be a buyer of options when volatility is low, and we have a checklist for this. So don't worry, we're going to give you all the rules and all the criteria. But keeping it simple, call options are an alternative to buying the stock when you want to buy. You could be buying call options on support levels. You could be buying call options on pullbacks, right? You could be buying call options on breakouts, all these things. Instead of us buying the stock, you can take advantage of using an option. Okay? Now, let's talk about this. Here's an example. For example, the call option is the right to buy. So for a $100 premium, so the options contract costs $100, I can buy the right to purchase 100 shares. It's always a fixed number of shares with options. It's always one options contract equals 100 shares, okay? And so the concept here is I can buy the right to purchase 100 shares of the stock for $75 on or before the expiration date. So the market value today is $75. Okay, the option buyer expects the price of the stock to go above $75 on or before the expiration date, and is willing to pay $100 for the right to buy the shares at $100 at the strike price of $75. So what that means is you're locking in the ability to buy the shares at $75. That's the whole point of the contract. Okay. Shares are trading here at 75. And then you're saying that, okay, in a week or so, whenever that date is, okay, in a week or so, you expect the price to be 80. Okay? Keeping it super simple for this example. So what you're saying is I'm willing to buy an options contract to purchase 100 shares, okay, at $75 before the contract expires. And then when the stock value goes up, you exercise your option and you make a profit on this spread because you have the locked in price of $75. You've locked in. It's like real estate, right? You can buy pre-construction and you can lock your down payments in at $200,000 per condo. The valuation of the condos increase by the time they finish building the buildings, and you exercise the right to put a down payment on the fixed rate. Same thing. The option seller, the writer in this regard, does not believe the price of stock will actually go that way. Therefore, they sell the contract to you. So you got to remember, there's always a buyer and a seller to every contract. So you're buying options against a seller that doesn't believe what you're doing is right. And that's the whole purpose, is there's always a market. So the purpose of this is you're locking in your strike price. You're locking in your valuation of the stock in expectation that the stock is going to go up in value. Okay. Now, let's continue this. The seller in this regard, okay, bears unlimited risk and limited reward. The risk is from a potential drop in the stock price, and the reward is from a potential rise in the stock price. The buyer, okay, has limited risk and unlimited reward in this environment. The risk is the premium paid, and the reward is from a potential increase in the stock price. Okay? So I just want you to understand that, when you're a buyer or you're a seller of options, okay, what happens is there's different risk profiles for taking that side of the contract, for taking that side of the position. And so let's take a look here. Let's say let's give you another example. Outcome number one, market rises. The stock price rises to 90. So I jumped the gun a little bit on that example, but I'm going to give you an example here. The stock price rises to 90. The buyer has the right to exercise the option or sell the option for a profit. Okay. So remember, you locked this in at 75. I said 80, but we use this for 90. So remember when this example, you locked it in at 75 bucks. The stock trades higher to 90. Okay. And what ends up happening is you can exercise the option and buy the stocks. You can literally, like, let's say you wanted to be a buyer of that stock and you wanted to own that stock. You could exercise those options. But most options traders aren't planning on doing that. They're not really getting involved in the stock. They're getting involved in the volatility profit. They're getting involved in the opportunity to take advantage of that option contract. So the point is you can just sell the option, liquidate the option and get out of it for a profit. No different than if you were to buy a stock at 75 bucks. Okay? Stock goes up to 90, you could sell the stock at 70 bucks. You could sell the stock at 90. So you bought it here, you sell it at 90, you make a profit. Same thing here. The only difference is your contract is making money on the spread. So what that means is you never actually owned the stock. You bought the right but not the obligation to buy the stock. That's the whole purpose here. And then you can just close the option contract and make money on the spread. So the cost of the option, 75 times 100 equals $7,500 plus a premium. Cost of the option is $7,600. The profit on this, $99,000, right there. So you made $1,400 on that move. That would give you a $1,400 move for having one options contract without having to participate in buying a $75 stock. Okay. And we'll talk about the benefits to all that. We'll talk about all that going into like why traders use the options and the cost of the options versus the stock and stuff like that, right? And we'll look at examples, right? And I'm going to go into the platforms and we're going to talk about the options chains and all of that stuff, okay? So the outcome number 2, let's say the stock falls. Okay, let's say the stock drops in price. So like if you have a call option, right? You had it at 75. Let's say you're wrong on that. The stock price falls to 60. Drops. You're not making money. And the buyer can sell the option contract for a loss. You can just get out of the contract and lose. They can also hold on to the contract in hopes it rebounds before expiration. Not recommended. This is not something we do. If by expiration the buyer chooses not to exercise the contract, the seller retains possession of the shares. No matter what happens, the seller keeps the premium. Okay, no matter what happens, the seller keeps the premium. So the scenario in this would you would take a loss. Okay, $75 times 100 shares equals $7,500 plus $100 premium. So the cost of that option contract is $7,600. And then when you get out of the position, okay, right there, you lose. So the main goal here is to understand that it's just an alternative to participating in the stock direction. Okay, outcome number 3. Repurchase at a discount. Okay, the stock price falls to 60 and the buyer sells the option contract for a reduced portion of the original investment, then immediately purchases the shares for a reduced price than originally priced at. This outcome qualifies that you spent the premium for the right to purchase the shares at a set price on or before the set date, or guaranteed the right to pay no more than the strike price. This outcome lets you participate in upside speculation and to capitalize on any advantages price drops in a stock you may have intended on owning at a cheaper price in the first place. So this is only if you're planning on participating in the stock in the first place. So outcome number 3 is not mostly what you're doing. But there's always going to be different scenarios, right? But that's the thing about options is there's many ways to skin the cat here. And like I said, we're keeping it simple. 9 times out of 10, you're looking at buying and selling the call option. That's it. You're not looking at getting fancy because most people aren't equipped to do that right out the gates for several years, actually. Most option traders just need to learn how to just get into the options industry and keep it super simple. Okay, so we're not looking to get all fancy because my job here with the course is to give you a strong foundation so that you can feel like you have confidently been able to look at how to use this to your advantage. Okay, so let's talk about put options now, the alternative to a call option. It's the opposite side. A put option gives the buyer the right but not the obligation to sell the underlying asset, so to short. So let's give an example. Stock's going up, consolidates, You're in a range, and you think the stock's going to drop. You're in a resistance level. Okay? So what this means is when you buy a put option, remember a buyer is both calls or puts. As a buyer, okay, you can be buying calls and want the stock to go up, or you can be buying puts, which is an alternative to shorting the stock. So even if let's say you're in a retirement account and you can't short the stock, then you want to buy puts because you can't short in retirement accounts. So that's what a lot of options traders do, is they take advantage of using options in retirement accounts. Okay, so what this means is you have the right, but not the obligation, to sell the stock. So the right is to sell a fixed number of shares at a set price on or before the expiration date. Put options are used when a buyer expects the price of the underlying to go below the strike price. Okay, so let's kind of keep it simple. Show you an example. Same thing. You think at 75 bucks, the stock is going down. Okay, so you buy for $100, the cost of the option. That's the premium. I can buy the right to sell short. In other words, I'm buying the right to short 100 shares of ABC stock for 75 bucks before the contract expires. And today the stock is worth 75 bucks. The option buyer expects the price to fall below $75 and is willing to pay $100 for the right to sell 100 shares. So normally you have 100 shares per one contract. It's always that. One option contract equals 100 shares. Okay? So the option seller does not believe the price of the stock will fall, therefore selling the buyer the option for a premium. So the opposing side of this trade, if you think the stock's going to drop, you buy a put option. Whoever you bought that put option for says, no, the stock's not dropping, it's going up. So they sell it to you. Okay, and there's a big market for this. It's not just one random guy sitting behind a desk, I'm going to sell you a contract. No, there's a huge liquidity pool of this. Like, it's no different than buying and selling just regular stocks. There's a huge market for the option space, okay? And so what ends up happening, okay, there's two risk profiles on this. The seller has unlimited risk and limited reward. The risk is from a potential drop in price. The risk is from a potential rise in the stock price. The buyer, okay, has limited risk and unlimited reward. So like I said, it's enticing for us to be wanting to buy the put. The risk is the premium paid. The reward is from the potential decrease in the stock price, right? As we talked about, we want the stock to drop in a put option example. So outcome number one, the stock price drops to $60. That's good, right? Because you bought it at 75, remember? We thought the stock was going up here, consolidate, and boom, boom, down to 60. You're feeling happy, okay? The stock is moving in your direction. You're making money on the options contract. So the cost is, $60 times 100 equals 6,000 plus the premium, okay? Profit, 75 times 100, you can see to do the math, okay? So the purpose of this was you took advantage of a directional play using an option as an alternative to the stock. Now, on the other side of this, it goes the other way. It goes up. You bought a put option, 75 bucks, and whatever happened, the market shot up to 90. You're like, oh no, didn't work for me. So you're going to take a loss on that trade because it didn't go work for you. No different than if you're selling a stock and it didn't go in your favor. Now, remember we said they can also hold on to the contract, hope it rebounds before expiration. Not recommended. Don't be doing this. Just take the stop out. If the stock's going against you and the option contract's going against you, just get out for a loss. Own the risk and move forward to the next trade. Okay? No matter what happens, the seller always keeps the premium. Now, outcome number three, remember we said we don't want to get fancy, but I'll explain it. The stock price rises to 90 and the buyer sells the option contract for a reduced portion of the original investment, then you immediately sell the shares for an increased price than originally purchased for. This outcome qualifies that you spent the premium for the right to sell the shares at a set price or before a set date, and were guaranteed the right to sell at no less than the strike price. This outcome let you participate in the downside speculation and to capitalize on any advantages, price increase in a stock you may own and previously purchased at a cheaper price. Now, this is only if you're participating in the stock itself. And realistically, like if you're in this course, you're probably watching this because you want to learn how to use options as an alternative to trading the stock. You're not trying to get fancy, right? So let's just keep it simple and focused on call options for longs. Okay. Calls, want to go that way. Puts, we want to go that way. Keep it simple. KISS. Okay. Not interested in trying to overcomplicate the options market. It's already a complicated environment. Okay. We don't need to make it overcomplicated. So when to use calls and puts. This is really important. This is a very important slide. I would really encourage you to take notes on this slide, print it off, take a screenshot. It's going to probably go in your trading plan. Okay, that's why I built it like this. So I keep it really simple. It's like a checklist. For the remainder of this course, we will refer to buyers of options as long positions. So it's a term. It's a term. When you say I'm long an option contract, that means I'm long calls or puts. Very important. So long position is not the same as all the other assets. When you say you're long the market, that doesn't mean, if you're long an options contract, it doesn't mean you're bullish. I know it's weird. When I first learned this, I said, why would everybody in the world do this? Why do they make it so complicated? Well, the truth is, that's the way the lingo goes. Okay. And for the remainder of this course, we refer to sellers, writers of options as short positions. Well, you could be short, and you could be short as a seller. You could be a long buyer. Remember, buyer doesn't necessarily mean bullish. Or you could be a short seller, and you can be short calls or short puts. Remember, as a seller, you're taking the opposing side of the buyer, so you're reversing the table, so to speak. So the main thing here is I like to keep it super simple. When we are a long buyer and bullish, that's the different thing. Like that's where I want you to understand. When we are a long buyer and bullish, we use calls. That's this one. When we are a long buyer and bearish, we use puts. That's this one. So that means we want the stock price to go this way. We want the stock price to go this way. Okay. When we are a seller of options, so when we're short seller and bearish, we use calls. Doesn't that make sense? Because we're selling to a buyer. So we want this. And when we are short and bullish, when we are a short seller or bullish, we want to get this. Okay? We sell puts. Because think about this, if you're an option seller, you're taking the opposing side of the option buyer, which means you're taking the reverse side of the trade, which means that, and this is where options trading gets a little bit more complex than just say, because now you're playing technically market maker as well, right? Like if you think about this, you're playing the game of a market maker. That's the best way I could probably put this. If you're a seller of options, you're participating in a market maker industry. And you're not really, but it's the same way. It's no different than if you're buying and selling any other asset. If you think about the brokers taking the opposing side of your trade, right? So that's the whole point, is when you're a seller of options, you're taking the opposing side of other people. Yeah, and when you're a buyer of options, you're participating in alternatives to the stock. And so this is very, 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 very important. The best thing to remember with options is that long means you're a buyer of the right, and you can buy both bullish or bearish, right, options. And short means you're a seller of the right, and you can be both bullish or bearish. So I think this is probably one of the most important slides of the entire course. Absolutely one of the most important slides of the entire course. And if you didn't understand this, please pause it, send an email, say, hey, Sean, I was just watching the options video on when to use calls and puts. Can you help me out here? And I will gladly help you out. But I think I did a pretty good job explaining this. and visually, hopefully that helps you. Okay. So let's move on. Portfolio insurance. So traders use options as a hedge to their portfolios to protect their holdings from a decline in price. Having options as a form of insurance on your positions limits your losses. It enables a fixed selling price, your strike price, which ensures a maximum loss limit until the option contract expires. So let's talk about insurance, because this is only assuming you have a stock or a portfolio and you're trying to hedge the downside risk. Okay. So I like visuals with options. I learn best with visuals. I'm assuming you will too. The stock price in your portfolio is declining. Okay. Here's the first 6 months of your stock, and here's the last 6 months of your stock. Okay. Well, your portfolio is going up and had a little pullback, and then it's going up and then pullback, and then up, and then all of a sudden, what's going on in the market? Got a bigger pullback, right? We're starting to go into a bear market. So basically, the stock prices in your portfolio are declining. The seller agrees to purchase them at a set price. This entails you exercise your options contract. The prices of your positions rise in value. There is no need to exercise your option, only loss. So essentially, let me explain this. You buy puts. If you expect your stocks to drop in value and you can't liquidate your positions, and it's a portfolio or you're holding on for more time, maybe you have to hold the stocks, maybe it's an RSP or an IRA or a LIRA or a 401k or whatever the case may be, what you do is you buy puts. Okay? You buy puts on your stocks, because not necessarily you're gonna exercise the options. You might just make money as the stock's dropping, and then right as you kind of get close to where the stock's kind of bottoming out, you exit your put positions and you just make money as the stock goes back up. This is the hedge right here. That's the hedge. It's insurance. Okay, it's an alternative method for you to collect, collect profits as one is going down, the other is going up. Okay, and it's just really a hedge against insurance. Okay, so this is a terminology review that I like to kind of leave this lesson with, because, like I said, option contracts are a little bit more advanced. So a call option is the right to buy the underlying stock. A put option is the right to sell the underlying stock. An option buyer has the person who has the right. An option seller, the person who has the obligation. The strike price is the price to purchase or sell. The premium is the price the buyer pays for the right. The expiration is the last day the contract can be traded or offset. The expiration date is the last day the contract can be exercised or assigned. Long positions are buyers of options, and you can buy or sell an option, calls or puts. And short, you are a seller of an option, and you have the obligation to buy or sell. Okay, and I want to kind of show you some examples. Now, I'm going to go over platforms in another video. Let's go in here and take a look at this as a platform here. Okay, this is a TradeStation platform. I've got a few different platforms. I've got TC2000 options platform. I've got TradeStation. I've got Thinkorswim here. We're going to start talking about that. I've got Questrade. These are all platforms that I kind of look towards using for options trading. If you're going to be an options trader, there's other platforms like Tastyworks and E-Trade and Charles Schwab and a few others that you could trade options on, and there's probably a whole lot more out there that I'm not even recognizing or naming. But for the most part, what I want to do is I just want to kind of talk a little bit about, how this all works as a trader, right? So I'm going to use this chart over here on the 60-minute chart. This is a 60-minute chart of, let's say, the S&P, the spiders, right? Well, there's a couple things you can do, right, as a trader. Let's say you wanted to participate in the spiders, right? The spiders is the SPY. It's tracking the S&P 500. It's an ETF. If you don't know what that means, please go back and watch the stock course. Okay. So the spiders is tracking the S&P 500, and essentially you know, if you're looking at this from a trader's perspective, that down here, when we hit support, okay, that's $325 per share of the ETF. That's a really big position. You know, you want to buy 100 shares of this market, that's a lot of money. So what you would do is you say, listen, if I believe that this is the low of the market, or I want to buy the market, and I want to make money going this way, then I would buy a call option. Okay? I'll buy a call option. Super simple. Let's say I missed the opportunity to catch the low. I wanted confirmation. I said, you know what? The market's not in an uptrend yet until here. Boom, we broke up. We made our first higher high in price. Okay? You say, okay, I didn't catch the low. Shoulda, coulda, woulda. I'm going to catch the pullback. I can buy a call option because I'm expecting the price to go up. All we're doing is using an option alternative to buying the stock. That's it. And there's more bells and whistles to it. Same thing up here if I wanted to, let's say, sell the stock. I believe that that's where I wanted to sell the stock. Okay? Or even better yet, let's say I was planning on selling the stock up here. Instead of me short selling, maybe you can't short sell, you're in a retirement account. Or maybe you just don't want to participate in the actual ETF. You would then buy a put option. Remember, you would buy a put. You wouldn't, just because you're wanting the market to go down doesn't mean you're shorting. You're not selling anything. You're buying a put, which is the right but not the obligation to sell. So when the put option gets executed, the ETF drops, and you're buying the put and you sell to close. You sell the put here, you get out of the position. You're out. So you make money as the market drops. And that's exactly what we're doing here, is we're looking at it as an alternative. Okay? And in order to participate in trading options, you're going to have to learn how to read the option chain. This is an option chain. This is calls and puts. So and we're going to talk about this after. We're going to go through all this information here because it's quite overwhelming in my experience to the new guy. It was for me when I started learning, but I was fascinated about learning this stuff. So I want to teach it to you in a way that is super simple, because I feel that there's so much information out there that really overwhelms option traders, and I don't want that to be the case for you. Okay, so what we're going to do is we're going to keep it super simple. A couple of things I want to do is if you've watched any of our other programs, I want to show you a couple platforms that we're going to be using throughout this example course. I have a TC2000 layout. I've built an options tab, the same platform we use for stock scanning. The only thing is that this platform is really sophisticated for options planning. It's got a lot of different bells and whistles for options planning, and so I've got calls and puts left and right here. So we're gonna go over this together. I just built this for the course here to show you how to set this up, and we'll go through it. I'll give you this layout if you need to get TC2000. If you're using TC2000, you can use this layout. And if you're not using TC2000, no problem. Because TC2000 is a brokerage in the US, but if you're in other countries, you can't trade through TC2000. You can use it for charting, it's fantastic. You can use it for scanning, it's excellent. But you will need to use an actual executable broker if you're not in the United States. Like, I'm Canadian, so I would use TC2000 for scanning, but then I would look to essentially go and execute on, say, a TradeStation platform for options. Or, if you wanted to take an example here, let's take a look here. You want to use, if I wanted to execute on, say, Thinkorswim. Thinkorswim's well known for options trading. So if we go over here to the trade tab, or monitor, give me 1 second here, tools, we'll go to analyze. Okay, so if you wanted to do this, you could go into the options chain. And this is a sophisticated options platform. So I don't want you to get overwhelmed here. We're going to talk about how to get trained on different platforms and that, so to speak. So if you're new to options trading and you've never traded an options contract, Thinkorswim is a well-known platform for options trading. TradeStation is well known for options trading, right? So if you're looking at charts, you want to trade the cues, the cues. We were just looking at the spiders, so let's go to the spiders. And so if I was expecting this, you know, this stock or this market to, you know, to go up, right? And, you know, I wanted to participate in this stock or this ETF, then I could buy call options here, and I could go over to the options chain in Thinkorswim, and I could do that. You can see there's calls and puts over here, and we'll get into the platforms, we'll get into the workspaces, we'll get into all that after. One other brokerage that I do recommend looking at is Questrade. So if you are in Canada and you're looking at, you know, opening up an account and you want to trade options, Questrade has a pretty intuitive layout. I like their charting. It's very straightforward. It's very simple, very clean and understandable. They're well known. They're Canada's largest discount broker, so they're very good. They're very efficient. And, you know, there's an example of the options chain. So this is what we're going to be talking about, the options chain in here. We're going to be going through it. We're going to be talking about it. And this is the exact same example we were just looking at, right? If we were looking at, you know, if I wanted to be a buyer of options here, or if I wanted to, let's say, participate here as a buyer of options, I could buy the option contract and trade that to the long side, right? Or if I wanted to be, if I was bearish, I could buy a put, right? But it's all about getting familiar with having an account and setting up a platform. You're going to need to have an options trading platform. We use other platforms like NinjaTrader, TradingView, and all that for futures and Forex and stuff. But for options, you definitely want to be using a well-rounded options platform. Thinkorswim is well known, TradeStation is well known, Questrade is well known, TC2000 is well known, E-Trade, Tastyworks is well known. These are other platforms. And if you need help getting set up with a platform, contact our support team and check with us, because we have an onboarding specialist, and we'll actually give you the pros and cons of each of the platforms, and we'll talk about which one to be using and why to use them and why we choose them over others. And I just think it's good that if you have some people's experience, then you're not just trying to go out there and figure things out on your own. Right. So I hope you enjoyed this first introductory video. It's a primer. Kept it super simple. My favorite slide on this course for this example is this one here. So you definitely just want to remember this. Okay. It's the most important slide here on this one, and also the last one for terminology. So let's go back down and find it right here. So those are the two I want you to really focus on and just kind of go run with it. And I'll see you, okay, in the next video. Looking forward to it, traders. Take care. Hey there, traders. Welcome back. I know you sure got a lot out of this video, but make sure you click the links below, because there's other videos that we're going to be teaching you valuable content in this series, and you don't want to miss out. Be sure to hit that subscribe button, and next, make sure you share this video with a friend, because this content is super important and they're going to get the results that you're going to be getting as well. So that being said, traders, make sure that you ask a question, leave a comment if you need some help below, and we can get social with you moving forward. Take care, and we'll see you in the next video.